It's official. Well, sort of official. Australia's heading for a recession. Now this is both good and bad news. I'm happy now that the news is out because we all sort of knew it anyway, didn't we? And now we can move on. Now I'm not trying to play down the severity of our problems, but I also know that the next stage of the economic cycle after a recession is recovery. Yes, the cycle's going to move on. Now just so we're clear, a recession is when our economy stops growing and has 2 consecutive quarters of negative growth. Of course, recessions are part of the normal economic cycle, and most countries have a recession every 7 to 10 years. Australia was the exception and hasn't had one for about 17 years. Now let's take a moment to look at what happens in a recession or with news of an impending recession. A recession pattern of behaviour comes over the average person, and this starts with fear. People are afraid that they may lose their jobs or that the economy is going to go down, so they stop spending. They take their bats and balls and they go home. They stop playing the game. However, one of the foundations of our capitalistic economy is that money gets recycled. It's recycling of money through the system. You see, it works a bit like this. You earn $1, so you go out and buy something. The shop owner gets the money and then he goes out and spends the same dollar and buys something else from someone else who again spends some money, and the cycle moves on. The problem is when the first person stops spending their money, the recycling of money stops and the economy slows down. Now if you multiply this effect by hundreds of thousands of people, all doing the same thing, then it ends up a self-fulfilling prophecy. The economy goes into recession because no one's spending. You actually helped feed that which you fear the most. That's of course why our government is trying to stimulate our spending with its handouts and its fiscal stimulus. Now of course there's much more to our current problems than just lack of spending. The dramatic deterioration of the global financial markets has driven much of the developed world into recession. While extraordinary monetary and fiscal policy action from governments around the world has seen interest rates drop and liquidity conditions improve, global economic growth will be weaker in 2009 than any year since World War II. In fact, the International Monetary Fund has called this coordinated global recession the Great Recession. So how does this affect you and me as property investors? During these times, people are scared of making big financial decisions. They don't buy new cars, they don't buy, sell or upgrade their homes. They also hold back from investing in property, and this translates to fewer people buying property, which usually leads to a fall in property prices. In other parts of the world, this has caused a significant drop in values, with prices falling between 10 and 30% in the United States and in the United Kingdom. Of course, this hasn't occurred in Australia. By and large, property values have held up well due to the severe shortage of properties, and more recently due to lower interest rates and increased demand from first home buyers. In its latest property outlook, the ANZ Bank suggests that while the Australian economy has held up remarkably well for most of the last year, 2009 will clearly be far more difficult. It predicts that our economic growth will continue to weaken throughout this next year as collapsing equity prices and rising unemployment weigh on consumer spending and as businesses pare back their investment plans. Nonetheless, the ANZ Bank remains confident that the Australian economy will come through the global economic downturn in far better shape than our developed world counterparts, in part due to the strength of our financial system. The ANZ Bank also suggests that house prices will remain resilient despite rising unemployment. They feel that Australian house prices will remain relatively well supported and won't experience anything like those spectacular falls that occurred in the United States and the United Kingdom and in many other developed countries. You see, they explain that the Australian housing market conditions are a far cry from those overseas. Conservative lending practices have protected us from the ravages of the subprime mortgage crisis, and our mortgage delinquency rates and our foreclosure rates have remained at historic low levels. There are also a number of other factors supporting property values. Firstly, unlike the United States, where there was a clear oversupply of properties weighing on their prices, the Australian housing markets have an increasing undersupply of dwellings. Also, Mortgage rates have fallen to levels not seen since the 1960s, meaning that housing affordability has improved dramatically. Then of course there's the doubling of the First Home Buyers Grant and the steadily increasing number of home buyers seeking finance approvals and underpinning the lower end of the property markets. Now all these factors give me confidence to go out and buy, but buy the right type of property. One that I can buy below its intrinsic value, in an area with proven, strong capital growth, and a property to which I can add value through renovations or redevelopment. 2009 is going to pan out to be an interesting year. However, our greatest opportunities come during times of change and turbulence, as does a tremendous chance to create long-term wealth and opportunity out of this mess. But not everyone's going to do well over the next few years. The gap between the rich and the average Australian is going to widen. The separation between the two types of property investors will become even more apparent. There will be those who are living in the past and think that all this that's going on is unfair. And then there'll be the financially fluent real estate investor who understands how to adapt and change in the current economic environment. They recognise that what we're experiencing is temporary. It's part of the normal property cycle, albeit at an extreme. This too shall pass. These sophisticated property investors see absolutely amazing opportunities currently because the field has been cleared for them. There's much less competition out there and property holding costs are much cheaper. While these investors will thrive in these difficult times, others will have difficulty surviving. Now in the seminars we're conducting around Australia, property tax expert Ed Chan and I have been explaining where we see the great opportunities are going to be. Now we've got 3 sessions left. We're in Perth this Saturday, the 21st of March, and then in Brisbane on Saturday, the 28th of March, and then our final seminar will be in Melbourne on Saturday, the 4th of April. If you haven't reserved your place yet, please click on the link below to find out more and reserve your place. Now in summary, if you've got a secure job and the ability to service a loan, and that's obviously become more easy recently, now's the time to consider buying a well-located residential investment property. Over the last few weeks there's been a flurry of activity mainly led by first homeowners in the $350,000 to $500,000 price range. In some of the areas that the team at Metropole have been buying in for clients. In fact, there are more buyers out there for the limited stock than we've seen in a long time. Now does this mean the markets have bottomed? Look, my honest response like in previous weeks has been, I've got no idea. But the answer is probably not. But again, my question to you is, are we buying the market? No. Clearly the answer is no. What I'm recommending is that you consider investing in a property that you'd be happy to hold in your portfolio for the long term. One which you could buy sufficiently below its intrinsic value, so that even if the market falls a little bit further, you'd still have bought well. In changing times like we're experiencing, no one can help you quite like the multi-award-winning team of independent property strategists at Metropole. Now, by the way, we help homeowners too. More of them lately as homeowners are getting back into the market, not just property investors. But remember, we've got no properties to sell, but access to every property on the market. So if you want to find out a bit more about what's happening in your local market and what our research suggests in store, maybe you join us at one of the free property briefings that we hold regularly in Melbourne, Sydney and Brisbane. Just click on the link lower down to find out more about our property briefings and reserve your spot. And finally, if you want to understand what's going on today and how you can thrive, not just survive in difficult times, please join Ed Chan and myself at our upcoming seminars, those last 3 in March and April. Please click on the link below. With all the changes that are happening in tax, finance and property, I believe you should really attend. Thanks, this is Michael Yardney.